Welcome back to the Hampton Roads Show. All week long we've been talking taxes with the professionals from Jackson Hewitt Tax Service. Today we're talking about commonly missed deductions, and joining us now to break it down for us is Toby McClarty. Toby, welcome back to the Hampton Roads Show. We're going to have a little fun with you again today over there in the buzz, but right now we're going to try to figure out about those deductions that are commonly missed. Can you name a few of them?
You know, at this time in the year, one of the things that a lot of people forget about is worthless securities. Maybe you've got a stock, you know, the last couple of years it hasn't been so great. Once it's finally declared worthless, you can write that off on your tax return, but you got to wait till it's dead.
Is there much savings involved with that? Basically,
whatever your cost basis is in that, your adjusted cost basis, you can deduct from your, there's a limit each year, and you might have to roll it forward, but there, it's a little bit.
Okay, and other deductions that people might have missed?
If you're really lucky and you got some gambling winnings in there, you can deduct the losses up to the amount of winnings. And then there's some employee business expenses that a lot of people forget about. Maybe you're traveling for work, going to seminars, maybe you have a temporary work location, you really normally work here in Norfolk, but they send you someplace else, and you have some expenses en route and when you're there, hotel, meals, that sort of thing.
Go back to the gambling.
Gambling.
That's kind of interesting. You say the losses incurred with gambling?
Right, up to the amount of winnings. So if you're buying that lotto ticket, because it's a big jackpot right now, keep those stubs, because if you win anything, you know, say you win $500, you can deduct up to $500 of the cost of the gambling. Your tickets up to the amount of winnings.
Now, you talked about saving the stubs, keeping the paper trail.
Right.
And that's really important because today's hot topic is about audits.
Right.
Now, should the average person worry about being audited?
I don't know that worry is the right word, but you always want to be prepared.
Okay.
We tell our clients 3 years is the general statute of limits. For an average person, keep your receipts for at least 3 years. You can, if you have a business, rental property, or you're deducting unusual things, you might want to keep them longer, 5 to 7. The IRS can go back indefinitely if they find a reason to, but generally they stay within a 3-year window.
Have you heard of many people after 3 years being visited by the IRS? That doesn't sound
we do, but there's generally a reason for it. The person has not filed ever or for that year. If you don't file for the year, then your 3-year statute of limits isn't ticking. So the IRS says, hey, you forgot to file 2005, and it's more than 3 years, but we'll still send you a letter.
Okay, so the best way to avoid an audit is to be careful of the red flags.
Right.
Do everything correct and make sure there's no big red flags out there, such as, what would they be?
Well, a red flag would be anything that's unusual, and just because it's unusual doesn't mean that it doesn't apply to you, so just keep your paper trail, like we said. You know, it could be you're claiming a child that's not your son or daughter, it's a niece or a nephew.
Right.
There's a reason why you're doing that, that's okay. If there's not a good reason, then that's a red flag.
So if your income goes up dramatically, or if you claim more giving, and maybe if you just got your Social Security number wrong.
Right. Now, a lot of things the IRS is going to reject immediately, and if your Social Security number and your name don't match the database that they use, then you will be sent a notification immediately. If you're electronically filing within 24 hours, you will get a notification to correct it. So a lot of those things are fixed right away. They're not going to be a long-term letter down the road. And there's more than the traditional audit that we think of, where you get, the letter, please do this. They will send a review. They'll say, hey, our records indicate that you had 4 W-2s last year, but there's only 3 on your return. What's up with that? So things like that.
Now, I talked about how they won't email you. They'll contact you by phone or by the mail.
Right.
And do they actually come to your door, knock, knock, glasses, briefcase, staring you down?
I won't say that it won't happen, but I've never heard of it happening. Generally, the letter is the most common. If you don't provide them with your phone number, then the only option they have is to mail it to you, which is nice, because then you get something in writing that says this is what we're looking for. As far as the email thing, that's a very important thing to know, because that's a huge scam. People emailing you, asking for personal information, pretending to be the IRS. The IRS will never email you. And in fact, we don't even report email addresses to the IRS.
That's a good idea. My tax return is prepared correctly. I have nothing to hide. Just a little paranoid about the IRS. I mean, I think most people are. If you are paranoid about your taxes and need a little bit of help, Toby here and all the good people at Jackson Hewitt Tax Service will help you out. Just visit them online at jacksonhewitt.com or call 1-800-234-1040. Toby's going to stick around and join us in the buzz in just a moment to talk more about taxes. Thank you.
Thank you.